Welcome to this presentation by Facilitators Research. This research is distributed exclusively for informational and educational purposes and does not constitute financial, legal, tax, or investment advice. For such services, you may reach out to speak to one of our officers.
Consumer finance is one of the fastest-growing subsegments of African financial services. It encompasses auto finance, microfinance, buy now pay later, salary-based lending, and a host of innovative digital credit products that serve retail customers outside the traditional bank credit system. With African consumer spending rising rapidly, urbanization accelerating, and digital distribution unlocking previously uneconomic customer segments, consumer finance has become a magnet for both entrepreneurial talent and institutional capital. This presentation examines the consumer finance landscape, focusing on the multi-billion-dollar companies that anchor it and the structural dynamics that will shape its next decade. Total consumer finance loan books across Africa exceed $30 billion United States dollars, with active borrowers exceeding 80 million when microfinance and digital credit are included. The top 10 consumer finance firms delivered average revenue growth of 22% in 2023, well above the broader financial sector. Approximately 35% of banked African adults use some form of consumer finance product, whether an auto loan, a salary advance, a buy now pay later installment, or a microfinance loan. This penetration is expected to grow rapidly as digital distribution reaches previously uneconomic customer segments. The consumer finance landscape includes both traditional lenders and digital natives. Westbank, a division of FirstRand, dominates South African auto finance with a loan book exceeding $7 billion. Letshego, headquartered in Botswana, operates multi-country microfinance with $1.5 billion. Bayport serves salary-based borrowers across multiple African markets. Capitec Credit, the lending arm of Capitec Bank, holds more than $3 billion in unsecured retail loans. On the digital side, Fairmoney, Carbon, Branch International, and Jumo represent the new wave of mobile-first lenders, with combined loan books approaching $1.2 billion. The contrast between traditional and digital lenders defines this subsegment. Auto finance is the anchor of African consumer finance. Westbank, a division of FirstRand, is the largest auto finance provider on the continent, with a loan book exceeding $7 billion United States dollars in partnerships with every major vehicle manufacturer operating in South Africa. Westbank's competitive advantage is its dealer network relationships, integrated insurance and wealth products, and sophisticated risk modeling built over decades. Outside South Africa, auto finance is provided largely by the universal banks themselves, with Mubadala Auto Finance in Egypt and Toyota Financial Services operating across multiple markets. As vehicle ownership rises across the continent, auto finance will continue to grow at mid-single-digit rates in mature markets and double-digit rates in emerging ones. Microfinance and salary-based lending is the second pillar of African consumer finance. Letshego, listed on the Botswana Stock Exchange, operates in 11 African countries with a loan book of $1.5 billion United States dollars and a focus on civil servant and formal sector salary-based lending. Bayport, with operations in 7 countries, holds a $1.2 billion book. Both firms have built sophisticated credit assessment models around employer deductions, allowing them to lend to customers with thin credit files at attractive risk-adjusted returns. The challenge for this segment is scaling beyond the formal salaried workforce into the much larger informal economy, where digital credit models are now making inroads. The digital lending wave is rewriting consumer credit economics in Africa. Fairmoney, a Nigeria-focused digital lender, has disbursed more than $4 billion in cumulative loans since inception, with a current loan book of approximately $350 million. Carbon, also Nigerian, has built a profitable digital lending franchise with $200 million in outstanding loans. Branch International operates across Kenya, Nigeria, Tanzania, and India, with a $250 million African book. Jumo has pioneered embedded credit, partnering with banks and mobile network operators to underwrite loans to mobile money users, with a $400 million cumulative disbursement book. These digital lenders operate with cost-to-income ratios below 20% and demonstrate that consumer credit can be profitably extended to customers with no formal credit history. Traditional and digital consumer finance operate on fundamentally different economics. Traditional lenders like Westbank, Letshego, and Bayport rely on physical distribution, employer salary deduction arrangements, and traditional credit bureau data. Loan ticket sizes are larger, tenures longer, and interest rates lower. Funding comes from bank deposits or wholesale debt markets, providing low cost of capital. Returns are steady, but growth is constrained by distribution economics. Digital lenders like Fairmoney, Carbon, Branch, and Jumo rely on mobile apps, alternative data, and automated underwriting. Loan ticket sizes are small, tenures short, and interest rates higher per dollar lent. Funding comes from institutional debt facilities and equity capital, with higher cost of capital offset by lower operating costs. Growth is constrained mainly by capital availability, not distribution. Consumer finance is the most heavily regulated subsegment after banking. South Africa's National Credit Act sets comprehensive consumer protection standards, including affordability assessment requirements and interest rate caps. Kenya, Nigeria, Tanzania, and Uganda have introduced specific digital lending regulations covering licensing, interest rate disclosure, and customer data protection. Most African countries now have operational credit bureaus, allowing responsible lenders to share borrower data and reduce over-indebtedness. Multi-country consumer finance firms face heterogeneous licensing regimes, complicating Pan-African expansion strategies. And regulators across the continent are tightening consumer protection codes, with particular focus on debt collection practices and transparency in pricing. Buy now, pay later is the emerging frontier of African consumer finance. As e-commerce penetration rises, integrated installment credit at the point of sale is becoming a significant new product category. Companies like Carbon, Fairmoney, and several bank subsidiaries have launched buy now, pay later products integrated with major e-commerce platforms. The structural advantage of buy now, pay later is that merchant subsidies reduce the effective cost of credit to consumers, expanding the addressable market beyond traditional salary-based lending. The challenge is unit economics. Ticket sizes are small, requiring very low cost of acquisition and underwriting to be profitable. Expect significant consolidation in this space over the next 3 years. In summary, consumer finance loan books will exceed $50 billion by 2028, driven by digital distribution and buy now, pay later adoption. Digital lenders will capture the majority of new customer acquisition, but traditional lenders will retain the largest share of total loan book value. Cross-border licensing under the African Continental Free Trade Area will unlock Pan-African consumer finance platforms within 5 years. And regulatory tightening on interest rate caps and debt collection will reshape unit economics across the subsegment. Consumer finance will remain the highest growth corner of African financial services. Thank you for watching this examination of consumer finance.